First of all, Happy New Year, everyone. For years, the skeptics called Clover Health a speculative bet. Hell, some still do. Today, the data is portraying Clover as a powerhouse in the making. We are witnessing a fundamental shift in American healthcare, the moment where a decade of what if becomes an undeniable what is. With membership exploding by 32% and adjusted profitability finally hitting the bottom line, Clover is no longer a startup fighting for survival. It is an AI-driven juggernaut that is currently rewriting the rules of the game. Billions of data points have finally met large-scale execution, and the results are undeniable. Today, we break down why Clover Health isn't just participating in the market, it's preparing to dominate it. So my goal is to hit all aspects of this company. This is a good video for all investors because we will recap some extremely important parts of the Clover Health growth story. Prepare yourself. The next hour just might change your perspective. So let me tell you a story. So that we can all kind of refresh our minds. Clover Health was founded in 2014 by Vivek Garipelli and Chris Gale. Garipelli had previously founded CarePoint Health, a hospital system in New Jersey. There, he saw firsthand the misalignment between hospitals and insurance companies. They were essentially at war, and the patients were sadly caught in the middle. Vivek realized that to fix healthcare, he couldn't just run hospitals. He had to control the payout, the insurance, to change how care was actually delivered. Clover Health was built on the ambitious premise that a technology-first approach could solve the deep-rooted friction between insurance companies and healthcare providers. By designing and utilizing its proprietary Clover Assistant software to give physicians real-time clinical data, the company aimed to lower costs through preventative care rather than restrictive HMO networks. Clover became a Silicon Valley favorite and went public via a high-profile SPAC merger with Chamath Palihapitiya in 2021. Its early public years were defined by volatility, including a scathing short seller report from Hindenburg Research, who is now out of business as of January 25. This was a period as a meme stock that saw its valuation swing wildly amidst regulatory scrutiny. Under the leadership of CEO Andrew Toy, who took the helm in 2023, Clover shifted its strategy from aggressive, money-losing expansion to a path to profitability. This involved exiting non-core businesses like ACO Reach to double down on its flagship Medicare Advantage plans and the SaaS-like potential of its technology. By late 2024 and into 2025, this pivot paid off as the company achieved consistent positive adjusted EBITDA and significantly narrowed its net losses. Today, Clover is evolving into a physician enablement company, leveraging a newly formed subsidiary, Counterpart Health, to license its AI-powered technology to other insurers and providers, signaling its transition from a struggling startup to a stabilizing tech-driven healthcare player. So now that we all got a good reminder of what Clover has gone through, we can really start to dig in. So what really is the company's moat? So when looking at the company, someone might say it's a small Medicare Advantage health insurance company. And from a very basic view, they would be correct. What most people will miss with Clover Health, though, is that it's not just a health insurance company. In fact, it's actually a technology company that has its own patient population to prove out its product. Counterpart Assistant is designed to assist physicians by aggregating available data and implementing it in an easy to understand yet highly impactful way so doctors can make data-driven decisions based on the Counterpart AI suggestions. It's important to note that the AI only ever makes suggestions and will never have the ability to deny care to a patient or tell the doctor what they have to do. Okay, so this slide here tells us what we need to know about Counterpart Health. Clover's unmatched performance is driven by Counterpart Assistant. This software platform is built for clinicians, and as you can see, it's the only unified clinical technology platform for managing quality, risk, and total cost of care. Okay, let's break this down one at a time. The data they have tells them that returning patients that see doctors who use Counterpart Health have a 1,500 basis point differential in MCR costs compared to patients who see doctors that do not use Counterpart Health. So if you're new to healthcare, MCR means medical cost ratio, also known as the medical loss ratio sometimes. This is the percentage of premium dollars an insurance company spends on medical claims or sick care. This is important to understand because Clover Health and many other insurers report using BER, or benefit expense ratio, rather than MCR. So the MCR focuses strictly on medical claims and pharmacy costs paid out by an insurer. The benefit expense ratio is a broader metric that also includes spending on quality improvement activities. Essentially, MCR shows what was spent directly on sick care, whereas BER provides a more complete picture of total healthcare related investments, including technology and programs designed to improve patient outcomes. So in this case, it helps to benefit Clover when using BER as a metric because they're spending on improving Counterpart Assistant, and that spend goes to their BER metric, along with many other things. Okay, so we understand now that MCR is more narrowed on the cost of taking care of someone. And if we go back to this post, they're saying returning members who use doctors who use Counterpart Assistant have an MCR improvement of 1,500 basis points, or 15% for returning members. But let's not glaze past the members in year 4 who have an average MCR reduction of 20% from inception. This is pretty massive. I will dig into some of the white papers in a little while to help explain how they are preventing disease and providing meaningful care for their members. So next, Clover Health's Medicare Advantage PPO plan has now been scored by HEDIS as the #1 PPO plan nationally for the second year in a row. In case you didn't know what HEDIS is, I'll break it down a little bit. HEDIS stands for Healthcare Effectiveness Data and Information Set. It is essentially a report card for health insurance plans. It is a standardized set of measurements used to see how well a plan is actually taking care of its members and providing quality service. This is so important to understand because when you understand this, and when you understand how difficult it is to operate a PPO plan, then you will understand why Clover Health is absolutely destroying their competition. So, HEDIS measures over 90 different areas, such as whether members are getting their cancer screenings, or how well the plan manages chronic conditions like diabetes or high blood pressure. The final scores allow you to compare plans apples to apples. High scores usually mean the plan is proactive about preventative care, which can lead to better health outcomes and lower costs for you in the long run. Essentially, HEDIS is a tool that holds insurance companies accountable for the quality of care that their doctors provide. Now, look, I get it. There's a possibility that you haven't heard of this technology, and you might just be a long-time healthcare investor or even a medical doctor. So if you haven't heard of it, how could it be? How great could it really be? Well, there's a 450% year-over-year increase in clinicians using this platform. How often do you see growth rate of 450% of something that sucks? You don't. This is a massive movement within the industry. It's quiet and it's sneaky, but it's coming. And when it gets here, it will be loud. The Clover Health and Counterpart Health teams are clearly working very hard behind the scenes. This is going to be extremely impressive in just a few short years. So, if you go to Counterpart Health's website, you will come across their white papers that describe improved outcomes for patients who have a primary care physician who uses Counterpart Health. Specifically, their white papers focus on COPD, heart failure, diabetes, chronic kidney disease, medication adherence, and underserved populations. I'm not going to go too deep into details on those here, but I'll highlight a few things. As you can see, in every case when a patient was treated by a doctor using Counterpart, they were more likely to be in the position to be treated earlier for a disease that the patient may not have understood that they even had. Counterpart helps to catch these chronic diseases earlier and therefore lessen the medical cost burden of getting the disease under control. And on top of that, it improves the life of the person who is being treated because they are getting the care that they deserve much earlier than they would have traditionally. So, deals made with Counterpart Health that we have been made aware of. So, we've been made aware of Southern Illinois Health signed a multi-year agreement with Counterpart Health back in February of 2025. Southern Illinois Healthcare has always been committed to providing exceptional care, particularly in the rural communities we serve, said Southern Illinois Health President and CEO John Antes. Counterpart Health's ability to deliver insights at the point of care helps us achieve better outcomes for our patients while enabling success in value-based arrangements. This partnership reinforces our mission to deliver top quality care in the most efficient, patient-centered way possible. Iowa Clinic signs a multi-year agreement with Counterpart Health to deploy proven AI technology to hundreds of providers across the Midwest. That's a pretty strong title in my opinion. We take great pride in being a leader in the adoption of innovative medical technologies and treatments, always with the aim of elevating the quality of care our patients receive, said Ben Villier, the CEO of Iowa Clinic. Counterpart's ability to harness clinical data to drive improved outcomes, combined with its intuitive design that understands the needs of practicing clinicians, stood out among other potential solutions and makes it a perfect fit for our organization. We are very optimistic about the immediate and long-term clinical and financial value it will bring to our providers and patients alike. The Duke Connected Care Counterpart Assistant deployment, January of 2025. Duke Connected Care supports Duke Health's strategies of delivering exceptional health outcomes and cost-effective health care in a way that fully engages patients and their loved ones with dignity and compassion, said John Yates, Executive Director of Duke Connected Care. One of our goals is to unify and optimize performance across our network of non-employed community practices. By leveraging cutting-edge AI technology, we are empowering our physicians with actionable insights and driving improved health outcomes. Some other partnerships that we're aware of, HealthTap, a virtual telehealth company. I find this one to be very interesting, and let me explain why. Some insurers have formal integrations or preferred provider status with HealthTap. These include traditional Medicare, across all 50 states, has access to use HealthTap virtually. Roughly 28.7 million people are on traditional Medicare. Numerous Medicare Advantage plans use HealthTap to provide virtual gap fill care. This is likely the current target for Counterpart Health to build confidence and create meaningful partnerships with other Medicare Advantage insurers. BUPA, or British United Provident Association, has a long-standing global partnership with HealthTap, affecting over 16 million members. And major commercial players. HealthTap accepts most major private insurance plans, for example, United Healthcare, Aetna, Cigna, and Blue Cross. These other insurers may notice that members who use HealthTap have all the benefits that Counterpart provides. Another important partner is the Heart House. This is a large medical practice specializing in heart health with several locations across southern New Jersey. They provide comprehensive cardiovascular medical services, including diagnostics, specialized care for diseases like AFib or congestive heart failure, and research. They host one of the largest cardiovascular clinical research departments in the region, offering patients access to new treatments and clinical trials. This helps Counterpart to study how their technology is improving lives and make changes based on the data. Two more partners, then we will move on to some other stuff. Vanguard Medical Group, a primary care provider based in New Jersey, is one of the early external partners to adopt Counterpart Health's technology. They see roughly 55,000 patients per year. This partnership is part of a broader trend where independent medical groups like Vanguard leverage advanced AI platforms like Counterpart to remain competitive against larger hospital systems, while maintaining their focus on personalized primary care. And finally, Ascend Medical is a tech-forward primary care provider known for its hybrid model, offering virtual care, mobile at-home diagnostics, and physical clinics with a focus on value-based care. Although not publicly disclosed, it is estimated that they see between 130,000 to 200,000 patients per year. The meaningfulness behind these partnerships is that eventually people will want to pay a lot for this kind of data-driven and proven technology. Technology that actually improves patients' outcomes and therefore makes them healthier while netting a tangible medical cost improvement. Eventually, this software will have a substantial per member per month price tag attached to it. The best part for us as investors today is that they haven't realized this information yet. And so we are able to accumulate cheap shares of a company that is killing it. And for the time being, nobody knows. So we went over Counterpart Health and how Counterpart Health drives better outcomes for patients whose doctors utilize their technology. This is the growth engine behind Clover Health. The flywheel says it all, and we're right back to step one now that open enrollment has ended. 1. Grow membership and Clover Assistant usage. 2. Deliver better AI-driven clinical recommendations. 3. Improve health outcomes and quality of life. 4. Reduce the total cost of care. 5. Reinvest in member benefits. I'm expecting another very strong open enrollment period for Clover Health this year, and assuming their current cohort is returning in 2026, we can assume a sizable improvement in MCR that will then be offset by massive growth from the new members. As they currently are, Clover is set up for many years of profitable and reliable growth that will only increase as their flywheel continues to ramp up. So I gave this its very own slide because it is quite possibly my favorite. It's a very easy to understand graph that lets us know that year one members on average cost Clover Health $110 per member per month, where returning members in year two are expected to earn an average of $217 per member per month because their needs have been met or mostly met. And so potential chronic conditions are now being more properly managed, and that leads to them having a healthier, happier life. This bump in profitability for returning members is a really important visual because it shows you just how fast progress can be made when you empower clinicians with clean data and actionable insights. And this is just the start. Think about this. Clover has worked incredibly hard for about 10 years now, starting from nothing, and now they have something that deserves recognition. But just like the profitability flywheel, their technology will only continue to get better with more actionable insights and data, and just more ways to empower doctors and make people's lives better. Okay, let's dig a little bit into the financials where that's headed for Clover. The company put up 33% membership growth in the previous open enrollment period, boosting their revenue exceptionally. Although they were aiming for profitability this year, in 2025, they, like many others, were hurt by the Part D subsidy. And this ended up greatly diminishing their profits along with greater year one membership utilization than originally anticipated. This is okay though. The fundamentals are intact and it simply has just added on time to reach a full year of profitability. See in the Q3 2025 earnings, Peter, the CFO, explicitly stated full year GAAP net income profitability for 2026. And that is why I want to mention the tailwinds that are propelling Clover further, because 2026 will certainly be a year where they can make some noise. So as you can see here, they are expecting strong retention of their current member cohort. They highlighted that their plan is effective when working on a 3.5-star payment year. And another important tailwind is that it is a 5% revenue increase for operating in a 4-star payment year for 2026. And we are expecting a CMS final rate notice to be favorable. This is due in the beginning of April. So as we can see, there is a lot of strong momentum building going into 2026. And even if the price action does not reflect the true value, we can be sure that this company is appreciating in value, even though it is not tangible to us as investors yet. So, a discounted cash flow calculator estimates how much cash a business will realistically make in the future, and then discounts those amounts because money waiting for you in the future is worth less than cash in your hand today, because of inflation, opportunity costs, or simply uncertainty or risk that a particular investment may hold. The calculation adds all those discounted future payments together to give you a single total value for the business right now. If that total value is higher than the current price, the investment may be a good deal, assuming you input all the correct data. See, that's the hard part. It's a projection, and so you're essentially trying to tell the future through numbers. It's not a perfect science, and in reality, it should not be relied upon heavily, but rather used as a mild guidance along with all your other due diligence. And please remember that this is not financial advice. So I took the full year projected revenue of 1.8 billion. And I'm assuming that's for 2025. And I am assuming we will be free cash flow negative in 2025. So I used the Albert Allen method of using 5% of revenue as free cash flow. But then I went ahead and cut that in half and started with 45 million in free cash flow to project out the potential intrinsic value range. I'm doing this based on the fundamentals of the insurance business, and I'm not accounting for any potential SaaS revenue that might come in the future. That's just icing on top. As you can see, I'm projecting high growth that ballparks around what the revenue growth was for 2025, then tapers off each year following that. And the final calculation shows today's value should be between $2.55 and $6.55 theoretically. Again, this doesn't take into account the 5% revenue growth for a 4-star payment year, SaaS revenue, or anything outside the insurance business itself. I'm of the personal belief that 2026 and 2027 will treat the healthcare sector much better than the last few years have. So, analyst ratings are an important point of data that we need to recognize. Although it's easy for them to lie to us, the consensus helps us to understand what might be reasonable to expect when looking into the future. I took estimates from both TipRanks and Zacks, and they are averaging in the low to mid $3 range for stock price. And as we can see on the average stock price target to graph, stock price target to price graph, the target does hold near the price, so watching for analyst upgrades can be a benefit to see improvement in investor sentiment and stock price discovery. Okay, contrarian investing. Going against the grain of what the norm would suggest, not following the crowd. Some legendary investors build their careers on this style of thinking. People like Howard Marks, Michael Burry, John Templeton, or David Draymond. I believe Draymond actually has quite an interesting strategy. See, he consistently outperformed the market by systematically buying low multiple stocks, those with low PE PE or book ratios that the market has discarded as dead or boring. Doesn't that sound familiar? Like how Clover was trading below book value? Maybe boring or dead stocks sound more correct. That's Clover Health, and Clover has taken leaps and bounds, and honestly, they are killing it. As you can see on the screen, the graph has two lines. The blue line in the S&P 500, blue line is the S&P 500, and the white line is the S&P 500 healthcare sector. We can clearly see a divergence on the 10-year chart roughly around 2022. At this point, we will continue to see bullish momentum into the healthcare. We will continue to see bullish momentum into healthcare, like Warren Buffett buying United Health or Michael Burry buying multiple healthcare giants in 2024 and 2025, like United Healthcare and Molina. We're likely to see the tides rise for healthcare soon, and even our small boat will float up with the rest of them, although we may rise on fundamentals and strong guidance as we move into the beginning of 2026 as well. All right, so let's dig into the weeds quite a bit with subdomains. Because we have not yet seen specific news releases on this subject, it is, for the time being, purely speculation. But it's still really cool and could have some massive clues to help us to understand where we might be going. So let me go over what subdomains are and their importance, and I'll touch on some of the fun stuff. So for Counterpart Health, subdomains are primarily used to create secure, isolated workspaces or tenant environments for their different healthcare partners. Instead of every hospital system or insurer sharing the same generic login, Counterpart Health uses subdomains to give each client their own dedicated gate to the platform. For example, a large healthcare system like Duke or the Iowa Clinic wouldn't just go to a general page. They would likely access the platform through a specific address like duke.counterparthealth.com. So why does this matter? Well, security. Since Counterpart handles sensitive patient data, using subdomains helps them to segregate data and security certificates between different health systems. Scalability. It allows Counterpart to roll out new features or updates to one partner, like staging environments, without affecting the live version of the software for other partners. And partner customization. Each subdomain can be configured with specific integrations for that hospital's unique EHR system, such as Epic or Cerner, while still running Counterpart Assistant at the core. Okay, so we know why they use subdomains now. What many don't realize is there are ways to search subdomains. And when we search through them, we find multiple occurrences of deals we already understand, with a few surprises like Humana and Summit. As you may know, Humana is the 4th largest health insurance company in the United States by market share, serving approximately 17 million members and generating over $117 billion in annual revenue, with a dominant specialized focus as the nation's 2nd largest provider of Medicare Advantage plans. Now, think about selling them a SaaS product, and even if it was $1 per member per month, we could see roughly $200 million in yearly revenue. That would be extremely high margin. That's obviously if they applied this across all of their patients. They do have 5.8 million Medicare Advantage members, and I believe it would be more realistic for Counterpart to capture that part of the Humana cohort first. Although at $1 per member per month, it is still highly respectable, around $69 million of high margin revenue if they were to capture their Medicare Advantage members. And let's be very clear, $1 per member per month is likely too conservative, where they could realistically charge $5 or $15 per member per month or more. Now, the other odd one that pops up is Summit. And I believe that this means Summit Health. Summit Health is a large multi-specialty medical group providing comprehensive primary specialty and urgent care services, primarily across the New Jersey and New York metropolitan area. The location of Summit fits well with the centralization of Clover Health in New Jersey. So, management team. Vivek Garapelli is the co-founder and current executive chairperson of Clover Health. Having previously served as the company's CEO from its inception in 2014 until December of 2022, he established the organization to address misalignments in the healthcare industry by leveraging data and technology to improve outcomes for Medicare beneficiaries. Andrew Toy is the current CEO of Clover Health and is a computer scientist at his core. He previously served as the company's president and chief technology officer, where he led the development of the Clover Assistant AI platform to help physicians improve clinical decision making. Peter Kuipers is described as a veteran in his space with over 25 years of experience. He is the CFO and is recognized in the industry for his financial leadership, notably receiving the San Francisco Bay Area Public Company CFO of the Year Award in 2018 for small to medium-sized companies. Conrad Y. is the Chief Executive Officer of Counterpart Health, where he leads the commercial expansion of Counterpart Assistant. Previously, he served as Clover Health's Chief Technology Officer. He now focuses on scaling the Counterpart Assistant technology to third-party payers and providers. His leadership leverages extensive product experience from previous roles at Hinge Health, Google, and Yahoo to drive the platform's mission of improving clinical outcomes through data-driven insights. Kevin Holub, VP of Product and Design, is oftentimes seen as a multimedia presence, but more importantly, he is the architect behind the user experience. Holub ensures the AI isn't just powerful, but indispensable for doctors. His expertise in machine learning is key to the platform's ability to think ahead of chronic diseases, making high-quality care intuitive. And Blaine Lindsay is the Vice President of Enterprise Growth and Partnerships at Counterpart Health. He is also one of the most active on social media, pushing a very bullish narrative when looking at the technology and the future of the company. He is tasked with driving national expansion by securing strategic partnerships with risk-bearing organizations and health systems to increase adoption of the company's AI platform. Lindsay is a recognized expert in value-based care, bringing previous growth leadership experiences from organizations such as Eledad, Honest Health, and Ansible Health. Okay. The Clover Health story is no longer one of survival, but of imminent dominance. By successfully bridging the gap between insurance payouts and clinical care through the Clover Assistant, the company has transformed from a volatile startup into a disciplined, high-growth technology powerhouse. We are witnessing the ultimate inflection point, a company that has spent a decade and billions of data points perfecting an AI that doesn't just manage care, but predicts and prevents catastrophe. This isn't just theory. The evidence is in the HEDIS rankings, where Clover's PPO stands alone at the top of the nation, and in their 1,500 basis point advantage in medical cost reduction. As the flywheel spins, moving members from their initial year into a high profitability maturity phase, the fundamental cash flow of the business is set to explode, just as the company hits its guided milestone for full GAAP profitability in 2026. What the broader market has yet to fully price in is the silent evolution of Counterpart Health. Clover is effectively a high-margin SaaS engine disguised as a traditional insurer. By licensing its proprietary technology to prestigious health systems like Duke and Iowa Clinic, and potentially tapping into massive member bases of giants like Humana, Clover is decoupling its growth from the risks of traditional insurance. This shift towards physician enablement creates a scalable, high multiple revenue stream that justifies a valuation far beyond its current trading levels. While the meme stock noise has faded, it has been replaced by a titan that is quietly becoming indispensable to the healthcare infrastructure of the United States. Now is the moment of maximum opportunity for a contrarian investor. As institutional giants like Warren Buffett and Michael Burry rotate back into healthcare, Clover Health sits as the sector's best kept secret. A lean, tech-first disruptor with an intrinsic value ceiling that continues to rise with every new partnership and the star rating increase. We are watching the transition from a dead stock to a market leader, with management led by computer scientists and financial veterans who have successfully navigated the path to profitability. The foundation is set. Clover is no longer a bet on what might happen. It is an investment in a machine that is already working, already saving lives, and finally, already winning. Okay. I really appreciate you watching up to this point. I just want to go over two final things. One, I am not a financial advisor, and nothing you see or hear on my channel is financial advice. I will continue to follow Clover with short updates when news becomes available. And I'd be doing a massive disservice to the community if I didn't talk about our stock trades platform. It is a true game changer for anyone serious about navigating the complexities of the market with confidence. While its financial stock terminal and highly praised tools, like the intrinsic value calculator and advanced data analytics, provide an incredible technical edge, it is the people and community that truly set it apart. Being part of Our Stock Trades means joining a collective of forward-thinking investors who prioritize education, integrity, and shared success. The culture fostered by the leadership and the vibrant, supportive community creates an environment where both novice and veteran traders can thrive, turning the often isolated world of trading into a collaborative journey toward financial freedom. Thank you all for tuning in, and have a happy new year.